welcome on board Sachin Shah, who's our guest for today. He's a fund manager with Emkay Investment Managers. Sachin, talk to us about how one should look at markets and how are you looking at valuations at the moment. Uh, Overall, you're seeing rates on the debt side start to creep up. Is this a time to take money off the table? But again, today we're seeing a bit of a rally in markets.
Yeah, hi. Thank you for having me on the show. So yes, I agree with you that the bond markets are getting a bit tightened. But I think as far as the Indian scenario is concerned, it's not so bad as compared to what we have seen in the global markets. In fact, if you think about it, the global interest rates, or say the US 10-year Treasury versus the 10-year GSEC, for many years we've always seen a window of almost 450 to 500 bips, which has now actually narrowed to almost 250 to 300 bips. And this is not very recent. This has now been for almost 1 year, where I think 250 to 300 bips, or about maximum 350 bips. And this is also thanks to, because the inflation differential, which used to be 450, 500 bips for last so many years, or at least the 2 decades that I have been in the capital markets, I think that has narrowed significantly in the last, I would say, 24 months, 18 to 24 months. And that's really helping the Indian interest rates to not shoot up beyond about 730 to 740 bips, 7.4, 7.5%. So I think we are okay broadly in that sense. The earnings yield is still far more attractive compared to the bond yield, is what I would like to believe, because the longevity of the growth that the Indian economy offers, I think is one of the best today. And I think that is something what we are extremely focused about.
Right. And in terms of your portfolio composition, how are you framing it up in this kind of an environment? Are you going more on the defensive side? What are the sectors you're seeing or you're believing that there is more value or juice in?
Sure. So I wouldn't say that we are going more defensive side, but yeah, for sure, at this point in time, we believe that the valuations are probably, we are much more comfortable in most of the large caps compared to mid or small caps, right? Because we believe that the current valuations in the mid and the small caps, and I'm saying generally, there will be always company specific, stock specific opportunities within the mid and small also. But broadly speaking, if you think about it, I think the mid and the small cap companies are discounting the earnings growth for at least next 2 years, FY25, FY26 fully. So, if there is any short-term disappointment in terms of the near-term quarterly results or some macro challenges, one can always see some knee-jerk reaction in the stock prices of mid and small caps. So we are at this point in time finding much more comfort in the large cap valuations relatively. And of course, within that, some of the sectors that we like are the secular sectors, whether it is private sector banking, automobiles, auto ancillaries, pharmaceuticals. Within the pharma, of course, we prefer companies which have presence in the domestic formulations business, or companies which are present in the global markets in the CDMO and the CRAM space.
So let me take cue from the first of those sectors, private sector banks, especially the larger ones. When I'm looking or comparing valuations, the likes of an HDFC, a Kotak, at least two of those names, we're seeing a large divergence in terms of the valuations versus the 5-year averages that we're seeing, almost trading at a 35+% when I'm looking at a 1-year forward price to book number. So how should one reconcile in terms of the valuations here, and is there a case for a larger rally in this particular space that you see?
Sure. So first, a disclaimer that yes, we own HDFC Bank in quite a few of our portfolios, and we believe that HDFC Bank today is probably not commanding any premium as it used to command, say maybe 3 years, 5 years back compared to its peer groups, right? I mean, as you rightly mentioned earlier. But the fact is that today it is one of the best quality banks. Their size, they're the second largest bank today after the merger. I mean, they were always second largest, but they've grown even bigger after the merger. Their asset quality is probably one of the in fact, the strongest, I would say, in the industry. And the growth, in spite of such a large size, continues to be in high teens. And, kind of the branch expansion that they've had in the last 5 years we believe will definitely help them sustain their deposit growth, because I think that's one very big concern that the street has, that the deposit growth will be not as easy as it has been in the past for HDFC Bank, and that will actually change the economics of the business for HDFC Bank in terms of their cost of funds. But we believe the kind of the branches growth that they've had in the last 5-7 years, they will start reaping benefits as far as their deposit growth is concerned, or as far as their liabilities growth is concerned. So we believe that the business economics, the spreads that the HDFC Bank has enjoyed over the last 2 decades or so, will probably continue for at least next 3 to 5 years. So their ROAs, we believe, will continue to be in the range of 1.8 to maybe 2.1% over the next 3 to 5 years. And with the current valuations, where probably the bank is trading at just about 20 odd times, 1 year forward earnings, we believe that a large part of the derating that had to happen over the last 2-3 years is we are already done with. The overhang of the merger is also behind us. So I think the earnings growth, and the most important today, the sector, everybody is doing well. But as and when there is a headwind in the sector, we believe HDFC Bank, as in the past, will stand the litmus test and emerge even more stronger.
So making a case there for HDFC Bank clearly, but let me also poke you on something relating to pharma. Talk to us about Divis. It's a large component of your holding in one of your funds. How should one look at Divis, and if not Divis, what are the other alternatives you would look for in terms of pharma?
Just a few. Within the pharma space, we are extremely positive on the CDMO and the CRAM space. And talking specifically about Divis, again, as you rightly said, a disclaimer also there that we own that business across a lot of our portfolios and also in some of our funds. So, we believe that Divis is a top-class management. If you look at their last nearly 2-decade track record since the company got listed, they have grown fabulously only through internal accruals, with a sustainable, consistent ROC of upwards of 25%. The kind of the capex that Divis has, is executing at this point in time, I think it's very, very unprecedented in their last 2 decades. I think the kind of the capex that they would have done in the last 7 years cumulatively, I think that's the kind of the capex that they are executing right now over the next probably 12-18 months. So we believe that the revenue growth is going to be very strong for Divis over the next 24 to 36 months. That's one. Second, we also believe that the margins, which have taken a hit in the last probably last 3 or 4 quarters, will come back very quickly over there in the next 3 to 6 quarters, because the last 3 to 4 quarters there were some challenges in terms of probably raw material sourcing and maybe a volatility in the global pricing. But I think all of that is behind, and Divis has very, very strong relationship with some of the large global pharma companies, and their confidence in the management and in the company, as far as their custom synthesis domain expertise is concerned, as far as their regulatory practices are concerned, as far as the delivery of materials on a timely basis is concerned, I think is very, very high, and it's proven even during the very, very difficult times of COVID. So I think the order inflows is not going to be a challenge for them. It's just about new capacities coming into play and they delivering over the next probably 12, 18, 24 months.
Right, Sachin, I'm going to make this very quick because I've been pushed to try and close this. But tell me, what in this earnings season has really stood out for you in terms of sector or company? Anything on the positive or the negative that's really stood out for you?
So I think the best part, I mean, it's a boring thing, but the good thing is that the banking sector results have been very, very picture perfect. And the other very good thing is that none of the managements at this point in time are highlighting any red flags as far as the asset quality is concerned. So that shows that the ground level reality is very, very strong, and that's a lot of I would say assurance for long-term investors like us.
Right. Thank you so much for that, Sachin. It's been a pleasure interacting, and it's been good having your views holistically. So thank you so much for your time. But we'll slip into a short break on that note. More on the other side, so stay tuned.